Iron Financial. Look, our mission here is simple. We are here to help you forge a stronger portfolio, cut through all the daily market weakness, and ultimately build enduring multi-generational wealth. We absolutely do not deal in speculation on this channel. We deal in structural integrity. So in today's explainer, we are putting on our hard hats to deeply inspect the latest architectural blueprint from one of the most formidable, entrenched entities in the entire global market, McDonald's. We're going to be drilling deep into their Q1 2026 earnings report, and we're also pulling back the layers on their massive SEC 10K filings. Now, why are we dedicating a whole explainer to this? Because McDonald's isn't just a restaurant, guys. It is a critical, real-time bellwether for the broader global economy. Exactly how the everyday consumer is choosing to spend their capital at these drive-thrus tells us literally everything we need to know about the current financial weather. We need to find out if this fast food titan is actively pouring concrete for future global dominance, or if their load-bearing beams are actually starting to crack under macroeconomic pressure. Now, I know a lot of you watching are naturally playing the role of the market skeptic today, and honestly, you should be. You're trying to parse through all the dense corporate jargon to find the actual truth. Management's out there talking a massive game right now about unparalleled unit growth and total digital dominance. But I have to ask the ultimate question right up front before we even think about laying down a single dollar of capital. Is this growth story pure hype, or is it actually real? Because let's be honest, on the ground level, we are constantly bombarded with headlines about a completely tapped-out consumer base. I mean, everyone has seen those viral receipts floating around online and felt the absolute sting of an $18 Big Mac meal, so we have to figure out, is McDonald's an ironclad cornerstone that you can safely add to your portfolio to weather an upcoming recession? Or is this actually a highly deceptive value trap that's just wrapped up in a shiny, predictable dividend? To answer that tension, we can't just skim the top-line press release and call it a day. We have to strip this down to the studs and examine the actual steel holding the structure together. Let's establish our baseline. For the full fiscal year of 2025, McDonald's posted a consolidated revenue of $26.9 billion. That represented a very solid, steady 4% growth rate. But now look at what just materialized in the first quarter of 2026. They delivered a massive 9% revenue spike, bringing in $6.517 billion in just 90 days. I want you to really think about the sheer physical inertia of a company that is already pulling in nearly $27 billion annually. Turning a massive financial cargo ship of that immense size and suddenly accelerating its top-line growth to 9% requires an unbelievable, almost unprecedented level of operational leverage. But of course, the immediate skeptical pushback is always, well, is that 9% just top-line fluff? Are they just rapidly throwing up new locations to artificially inflate the revenue? That is exactly why we have to look at the core metric of overall restaurant health, which is comparable sales. In Q1 2026, global comparable sales, meaning sales at restaurants that have been open for at least a year, increased by 3.8%. This is an absolutely critical data point for us. Why? Because it represents a complete 180-degree trend reversal. Just a year earlier, they were staring down a 1.0% decline in this exact same metric. So seeing this bounce back to a positive 3.8% proves that the underlying foundation, the existing physical footprint that's been operating for years, is actually strengthening. They aren't just relying on shiny new construction to prop up a bleeding balance sheet. They've effectively arrested the bleeding from the prior year. Now, percentages are great, but they only tell us so much. Let's look at the sheer raw volume of cash moving through this system. System-wide sales, and remember, this includes every single dollar flowing through all locations, whether they are corporate-owned or run by independent franchisees, hit an unbelievable $34 billion for the quarter. That equates to an 11% overall increase. However, as disciplined investors, we need to strip out the noise. To see the real, organic heavy lifting done by the operations team on the ground, we have to factor in the global Forex markets. When you adjust for a strong US dollar, which naturally eats into their overseas revenue translation, their constant currency growth rate sits at a very solid 6%. That 6% is the actual ground-level operational reality. Foreign currency translation mechanically added about 13 cents to their diluted earnings per share this quarter, but you absolutely cannot build a long-term investment thesis just hoping for favorable exchange rates. The organic 6% is what proves the engine is actually running hot. So if we ignore that currency boost, where is all this massive organic customer engagement actually coming from? It is generating directly from their digital reinforcement. Honestly, this is probably the most vital structural upgrade to their entire business model in the last 10 years. Across their top 50 loyalty markets, system-wide sales to active loyalty members accounted for over $9 billion in the first quarter alone. Let that number really sink in for a second. $9 billion. That is cash extracted from a dedicated, tracked, and highly engaged customer base in just 3 months.
And when you look at the trailing 12-month period, that loyalty foundation sits at an ironclad $38 billion. Listen, this isn't just a fast food company selling burgers and fries anymore. It has fundamentally evolved into a highly optimized global consumer data platform. They know exactly what you want, when you want it, and exactly how to push you to buy it.
Having massive revenue and sticky loyalty metrics is fantastic, but it doesn't mean a thing if the internal costs of running this giant machine eat up all the cash flow. So let's trace this down to the actual bottom line. The structural translation here is incredibly robust. Operating income surged to $2.95 billion, which is a 12% increase. Net income reached $1.98 billion, up 6%. And their diluted earnings per share expanded by 7% to reach $2.78. But the true structural marvel we need to focus on here is their margin guidance. Management is projecting a 2026 operating margin in the mid to high 40% range. Let me repeat that, mid to high 40%. In an era where literally everyone is getting crushed by skyrocketing labor and commodity costs, maintaining a mid-40s margin is practically unheard of. It proves their operational structure, from automated drive-thrus to supply chain dominance, is incredibly dialed in. But you don't get margins operating at that high of a frequency or tens of thousands of locations without pouring a ton of fresh concrete. So let's transition to the heavy lifting, their capital expenditures. If we trace their historical capitalization strategy over the last 3 years directly from their SEC filings, it reveals a tremendously aggressive ramp-up in spending. Back in 2023, their capital expenditures sat at $2.35 billion. By 2024, they scaled that up to $2.77 billion. And in 2025, they aggressively poured $3.36 billion right into the ground. This is all primarily focused on their internal accelerating the Arches development pillar. What they are doing here is actively and aggressively accelerating their capital deployment. They're essentially buying future market share right now. And they are turning the dial up even further for this year. McDonald's is projecting an absolutely massive 2026 capex between $3.7 and $3.9 billion. Now, you might be thinking, whoa, laying out nearly $4 billion in a single fiscal year, especially with borrowing costs being what they are right now, is a massive gamble. And you'd be right to question it. The overwhelming majority of this capital is being deployed specifically to build new restaurant units across the US and their international operated markets. They are distinctly not pulling back. They are not playing defense in the face of all this economic uncertainty. They are actively choosing to build right through the headwinds to capture vital market share, while their weaker, undercapitalized competitors are forced to retreat and close their doors. So if they are going to deploy that kind of massive leverage, we need to map out exactly where this money is going. Here is the precise step-by-step geography of their 2026 blueprint. Step 1. They plan to open approximately 2,600 gross restaurants globally. Step 2. About 750 of those will be directly in the US and international operated markets. Now, Step 3 is where the real genius structural leverage happens. They rely on their developmental licensees and affiliates to contribute their own capital towards more than 1,800 openings in their respective markets. Finally, Step 4. After accounting for underperforming closures, they expect about 2,100 net restaurant additions this year alone. By utilizing partner money, affiliate capital, for the absolute bulk of the new openings, they expertly insulate the main corporate balance sheet from the heaviest developmental risks. They collect the franchise fees while someone else pours the concrete. But 2,100 net additions in just 1 year is a blistering pace. What is the ultimate endgame of this relentless expansion? The overarching architectural goal is to achieve a global scale unlike anything the fast food industry has ever seen. By the end of 2027, McDonald's is officially targeting 50,000 global units. Just to put that sheer physical footprint into perspective for a second, there are only about 40,000 total grocery stores in the entire United States. McDonald's wants 50,000 restaurants globally. They ended Q1 of 2026 with 45,699 locations, meaning this aggressive push marks the absolute fastest period of unit growth in their entire corporate history. They expect this net restaurant unit expansion alone to structurally contribute roughly 2.5% to their 2026 system-wide sales growth. This is the literal definition of forging a durable, inescapable global empire. Okay, Section 12, cracks in the armor. We've looked at the massive scale, but every massive building has structural vulnerabilities, and it's time for us to grab the flashlight and look for the real cracks in this foundation. You absolutely cannot build a 50,000-unit empire without facing brutal, systemic macroeconomic headwinds. And when we dive away from the glossy earnings press releases and look at the legal reality of their 10K filing, a much more precarious narrative emerges. Look at these specific systemic risks threatening their foundation right now. First, you have sustained inflationary pressures heavily impacting raw commodity and local labor costs.
Second, shifting disposable income levels. Third, and perhaps most critical, discerning consumer spending habits. Listen, the everyday consumer is feeling the squeeze right now. They're trading down from premium items, or they're just deciding it's altogether cheaper to stay home and cook. A severely squeezed consumer base could easily shatter this entire Q1 growth narrative we just walked through.
Now, you might be thinking, well, isn't that just standard legal boilerplate that every company has to include? Sure, every multinational has to list economic downturns to protect themselves from liability, but the explicit phrasing here is what matters to us as investors. I'm going to read this exact warning directly from page 32 of their 10K risk factors. Our results of operations are substantially affected by economic conditions, including inflationary pressures, which can vary significantly by market and can impact consumer disposable income levels and spending habits. This is their own highly paid legal team explicitly acknowledging that their top-line growth is extremely vulnerable to a tapped-out consumer. This isn't just market hype we are inventing, it is a legally recognized structural liability. And that vulnerability brings us perfectly to the double-edged sword of their entire corporate structure, the 95% franchised reality. Of their roughly 45,000 current locations, 95% are run by independent franchisees. On one hand, corporate has built a massive financial shock absorber. It heavily insulates the corporate margins because corporate collects rent and royalties right off the top, regardless of whether the local store is actually turning a profit. But here is the massive structural flaw in that design. It pushes all of that intense local labor and commodity cost pressure directly onto the franchisees who actually pour the sweat to run the day-to-day operations. If those local franchisee cash flows compress too hard because of inflation, the entire chassis of the company breaks down. System-wide remodels will halt, and that massive 50,000 unit expansion plan will stall completely. Which brings us to the most crucial metric I want to challenge today. I really want you to consider deeply if that 3.8% comparable sales growth we discussed earlier is being driven by genuine organic guest count growth, meaning real foot traffic, or is it simply a temporary, unsustainable sugar rush resulting from aggressive menu price hikes? Are they just masking a terrifying scenario where 5% fewer people are walking through the doors, but the ones who remain are simply paying 10% more for their meals? Because their own 2025 financial performance explicitly noted that comparable sales benefited from average check growth. Listen, if you keep charging a shrinking pool of customers more money just to protect your margins, eventually that elastic band is going to snap. You lose the value-conscious consumer entirely, and the whole foundation crumbles. Section 17, the final verdict. We've inspected the bullish blueprints, and we've stress-tested the cracks in the macroeconomic armor. Now, it's time to decide if this is an opportunity or a trap. To make that final verdict, we have to look at exactly how management treats the people actually providing the capital, the shareholders. And right now, they are aggressively returning cash, which signals immense underlying confidence. In Q1 2026 alone, they paid out a massive $1.86 per share quarterly dividend, totaling $1.3 billion. They also executed an aggressive stock buyback program, repurchasing 1.3 million shares for $393 million. What is absolutely critical to note here is the ratio. Deploying over $1 billion in direct cash dividends versus roughly $400 million in buybacks shows they are prioritizing putting tangible, hard cash directly into investors' pockets over mere financial engineering. Doing all of this while simultaneously funding a $3.9 billion capex program, that demonstrates absolute unwavering faith in their free cash flow generation. So let's rapidly weigh the balance here between the solid foundation and the macro headwinds. On the opportunity side, you have a globally diversified, ironclad titan. You have a $38 billion trailing 12-month digital loyalty engine that practically prints consumer data. You have consistent 6% constant currency system-wide sales growth, a bulletproof mid to high 40% operating margin, and unparalleled real estate dominance. But on the trap side of the ledger, you have a tapped-out, highly discerning consumer facing sustained inflation, literally deciding between paying rent or buying a premium burger. You cannot ignore the immense pressure on local franchisee profitability, and the severe lurking risk that top-line growth is just a mirage masking declining physical traffic through completely unsustainable menu price increases. And that brings us to the final critical decision for you. We have handed over the unvarnished blueprints, we have rigorously stress-tested the financials, and we've put a spotlight on the structural vulnerabilities. Now the choice belongs entirely to you. Are you going to pour your capital into this foundation, trusting the unparalleled scale, the massive digital moat, and the aggressive unit expansion to deliver ironclad returns? Or is the sheer risk of a consumer collapse and inflationary pressure just too heavy of a load for your specific portfolio to bear? Take these numbers, cut through the daily market noise, and decide exactly how you are going to forge your financial future today. Thanks for joining us on this explainer at Iron Financial. Stay disciplined out there and keep building.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.